This is News Always On. Spotify is making its Wall Street debut in an unconventional way. It's using a direct listing on the New York Stock Exchange that will allow the company's early investors and employees to sell as many shares as they want whenever they want. That's a departure from a traditional initial public offering in which a company and a few select investors first sell a limited amount of stock at a starting price determined by investment bankers who spend weeks gauging investor demand. The direct listing could result in wild swings in Spotify's stock pricing during the first few days of trading, especially since Spotify shares sold in a range of $48.93 to $132.50 in privately negotiated transactions during the first 11 weeks of this year. Spotify's share traded as high as $169 before falling back slightly. By the early afternoon, the stock was still hovering around $155. The stock market's rousing reception left Spotify with a market value of about $29 billion. Spotify currently has 71 million worldwide subscribers and hopes to increase that to 96 million subscribers by the end of the year.
The difference is, in an IPO, the company is raising money. They're selling additional shares, typically the night before their initial listing. With a direct listing, there is no capital raise. They just begin to trade as a public company. The volatility was the big question today for Spotify. Our team here at the New York Stock Exchange, working with the financial advisor Morgan Stanley, the bankers Goldman Sachs, Morgan Stanley, Allen & Company, and the company Spotify, did a great job setting it up for success. We rolled the ball out on the court, we let the floor community do their thing, and the stock is trading very smoothly.